Joining us right now is Dan Skelly. He's Morgan Stanley's Wealth Management Managing Director. And Dan, thanks for coming in today.
Morning, Becky.
A lot of talk about how this is the worst week we've seen since August 1st, but we're still talking about 1% declines or less for the major averages, and maybe that tells you more about where the markets have been recently. People keep thinking this is time for a pullback. There's time for a pullback. What do you think?
Becky, first off, we've blown past the seasonally weak period. So I think that was the time frame everyone was expecting that pullback. So it's telling you a couple things. First, the economy continues to have a tremendous amount of momentum. We saw that in GDP revisions this week. The AI supercycle continues to power the big mega cap tech parts of the market as well. So we would just say we've been due for a consolidation, although the momentum in the economy and the AI story continues to suggest it won't be a huge correction.
Meaning, if stocks pull back, do you see that as a buying opportunity, or would you put money to work right now?
So we're always, in wealth management, we're always saying today is a good day to invest, because so often our clients are investing for retirement, savings, college spending, et cetera. Those are long-term time horizons. And as we well know, the market pays us back over those time periods more often than not. So
what if you're somebody who's nearing retirement?
Yeah, we'd say maybe to be a little bit more conservatively oriented and focus on dividend growth or dividend income stocks, which candidly has actually been one of the worst performers in the last 6-12 months, as it's been more of a risk-on growth market. So it really depends on where you're coming from.
You are of the opinion that this bull market still has a long way to run, though.
Absolutely. If you look at history going back something like 50 years, we've seen 5 bull markets since 1950. And in that period, the average length is about 8 years. So we're 2.5+ years since the ChatGPT lows in October, November of 22. So we don't think we are close to a bubble-like condition. We would also offer, as much as growth in Mag 7 has led, back in 99, the technology sector, the NASDAQ, was something like 50% above its 200-day moving average. Mm-hmm. Today, the NASDAQ's trading about 12% above that moving day average. So it's nowhere near as extended as it was in that prior cycle.
Some people think we're early cycle starting now. One of your guys, Mike Wilson.
One of my good friends.
And I think he might date something to the Liberation Day. Where'd you go back to, the ChatGPT?
We're saying October of 22 is where that bear market ended in 22.
You don't. So what was that? What we had in April of this year? That was just a backing and filling consolidation. That wasn't the start of anything new. We got a bear market in wasn't the NASDAQ down 20?
Sure, the NASDAQ was down 20.
So
and
you could date the new bull from then. And then you got another 2 years.
You could. I think that's definitely maybe stretching a little bit. But I think to Mike's point earlier this week, Joe.
You will watch it?
Of course, yeah. Never miss him.
You never missed the show. I think you
never missed the show.
You meant to say.
Never missed the show, and he happened to be on.
Okay.
But to your point, ISM manufacturing has been sub 50 for 3+ years. So in this kind of weird environment, with winner-take-all technology, high interest rates, there's been this concentrated market. And I think there might be some element of broadening out, no doubt, as the Fed is cutting and as the tax cuts take effect. You could see some broadening.
You like healthcare?
We do, and it's
explain the valuation of healthcare right now and why you like it.
Sure, Becky. So look, healthcare has, like those more defensive dividend names, been in the doghouse for the last several months and years. Policy has been an overhang.
Yeah, I was going to say there's a reason for it.
No doubt.
No matter what party's in power, they're
no doubt. It's been fairly efficient, we think, in terms of higher rates impeding biotech in particular, which is duration-oriented and a little bit more dependent on rates. It's been frankly, the COVID pull forward, which couldn't be extended, right? So a lot of analysts are still trying to normalize for post-COVID type earnings, number 2. And number 3, policy. So look, we would just argue at an 8% weighting in the S&P, healthcare is trading at the lowest relative weight in the market since 1994. So we think policy is largely priced in. I wouldn't say all priced in. You always get burned when you say all priced in. Largely priced in. Big Pharma's trading at like a 30% discount to the S&P. And this will be, over the longer run, one of those industries that's transformed positively via AI.
Even with the news coming today from the administration that the president is looking to impose 100% tariffs on any drug company that's not building and manufacturing here in the United States?
It's an excellent point. If you look at 2 things. First, I think many of the pharma names are trading up as of this morning.
A lot of them already are building plans.
Very good, right? So a lot of them have committed in recent months to building already. Number two, if you look at the precedent with the semi-tariffs going back a couple months ago, it was a 1 minute, 1 hour shock. And then the semi-index is now 12% higher than when that tariff announcement was made. So I think the market is becoming more and more accustomed that tariffs are going to be this feature and not a bug going forward.
What would change your mind? What do you look for around the edges? Only because if everybody's certain that this keeps going higher, there's going to be something that surprises us at some point.
So if you had asked me that same question a year ago, I would have said the Middle East. I thought that was a particular risk factor that wasn't priced, with oil trading consistently in the low to mid 60s. And look, I would say arguably today the geopolitical risk factor in Ukraine and in Eastern Europe is certainly seemingly getting more concerning on the margin. And I think that might be a risk.
Saying we're at the closest point to war with Russia than we have been since the Cold War.
It's concerning. And it's one of those factors, unlike earnings and cash flow, it's not quantifiable per se, as you know, but we would just argue, again, oil trading in the low to mid 60s, it feels like this has been such a strong consumer-driven economy that were we to see more geopolitical concern there and a higher oil price, that could be a problem.
How confident are you in your assessment of this? If you put it on a scale from 1 to 10, if you put it on a historic scale, however you want to measure it?
I would say today, given the tax deal, given the enthusiasm around AI, given this has increasingly become a concentrated high-end consumer economy where the rate sensitivity in that particular cohort is not as high, I'd say we're very confident that we're not going to see recession, no doubt, and we're not going to see, to your earlier point, Becky, drawdowns really bigger than normal, maybe 5–10% at most. And last thing I'll say to that point is, I think in April it brought people a lot. It brought a lot of people back to investing 101. It was a 20% drawdown realized in 4 days. But those bear markets tend to pervade in one of three categories: economic recession, year-over-year earnings contraction, or the Fed hiking. And what we were advising clients in April, none of those three conditions were in play back then, nor do we think they are today. In fact, we're talking about the Fed cutting rates.